Well, hey there, everyone. Hello, hello, hello. Happy Thursday. Welcome to our weekly Biz Money Q&A. Let me adjust this real fast. So we have an awesome question today. I'm actually so freaking excited about this question. Y'all may not be, but I'm really excited about this question because this has to do with a really big issue, frankly, that's going to come up because of 2020, because of COVID. It's going to be an issue with folks 2020 taxes. So I'm really excited that this is our question for today. So let me go ahead. And by the way, folks who are watching live, welcome. Thank you for joining. If you have Biz Money questions, feel free to drop them in the comments. I will get to them if we have time. But let me go ahead and just dive into this question. This comes from I think this is from, yes, Brad Licia submitted this, been a member of our group for quite a while. So thank you for this question. Let's dive in. So the question is, I was living in LA when COVID hit, but went to stay with my mom in Tennessee until the pandemic blew over. Yep, I think a lot of people did that. Do I count any of my travel and food expenses as business expenses during the time I was in Tennessee or no? Yeah, so let's just back up real fast here. I think that I started this off by saying, I'm glad you brought up this question because it deals with what's actually going to be a really big issue this year because of, or in 2020 at least, possibly into 2021 because of COVID. And that is folks basically going to other places, not necessarily moving permanently, but going to other places. And I'm going to talk about that in a second, but I want to answer your direct question first. So you're asking, can you count any of your travel and food expenses as business expenses during the time that you were in Tennessee or no? And the answer, unfortunately, is probably no. So let's break them down. You've got travel and you've got food. So when can we deduct travel expenses? You can deduct travel expenses when the travel is for a legitimate business purpose. So if you had gone to Tennessee for a business conference, for example, then you could deduct the airfare, you could deduct the hotel, things like that. But because you went to Tennessee because of COVID to live with your mom, that's not really a business expense. And even more so, it's not like I'm trying to give an example. Like it's sort of a two-parter, right? Like you went to Tennessee because of COVID. That isn't a business expense, like unfortunately. And you also there was nothing in Tennessee that had to do with your business. So it wasn't like you went there for a conference or, you moved your business there, like, or you were going to open up a new location there or something. Like there was nothing there that was related to your business. So because of that, unfortunately, the travel is probably not deductible unless anything I said in my assumptions was wrong. Let me know if it was. Food is a little bit different with travel. So people always think, and I don't blame you for thinking this because it seems reasonable, that when you travel for business purposes, that you should be able to deduct your meals. I used to, when I was in public accounting, I would go, for weeks at a time, I would go out to client sites and we would stay at hotels, right? And we'd have to buy breakfast and lunch and dinner, and it really added up. Now, my company gave me a per diem, but I used to think like, this should be a tax deductible expense, right? Well, at the end of the day, it wasn't in many cases. Because what happens with food when you're traveling is it follows the same rules as meals generally, which is that generally you can only deduct 50% of meals, and you can only do that if they are related to business. So, and I'm not going to get into like all the specific rules here, but basically you take a client to lunch or, well, that's really the big one. You take a client to lunch, something like that. You can only deduct 50%. And the reason is because the IRS basically says you shouldn't get a deduction for feeding yourself, because that's an expense that you would have regardless of the business. Now, the reason why I think it's reasonable to say that's unfair is if you're forced to travel, you may not have access to a kitchen, you may not be able to get groceries, and so you end up spending a lot more money. I get that. Unfortunately, that the IRS doesn't agree. And so even when you're traveling, you're still limited to excuse me, to 50%. My husband cooked this morning and like the peppers are still in the air, so I'm coughing. You're limited to the 50%. And again, it's got to be meal expense related to something to do with the business. Now, there are some other rules around deducting meals, like there's a for the convenience of the employer rule and things like that. I'm not going to get into that because it doesn't really answer your question. But the long and short of it is, unfortunately, in this situation where you travel to Tennessee for personal purposes, you can't deduct any of your travel and food expenses. I also want to mention something here too, because this comes up a lot, especially with business travel. Like, let's say you have I'll give you an example. I had a business conference a few years back in Miami. And so my company paid for me to go. But if I was a business owner, that would have been a business expense, right? So now let's say I decide to take my whole family and I decide to make it a big vacation. Once you do that, you threaten the ability to take that as a business deduction for your business, because now you're really turning it into a personal thing. There are rules about like how much, and you can do a little bit of personal as long as most of it's business. Again, I'm not going to get into the specifics today, but just know that in order for travel to be deductible, it really does have to be, it has to be related to the business. It has to be reasonable for the business. So like it's snowing here. If you're a plow driver and you take a trip to Florida, to meet, I don't know, to whatever, to Florida, you can't like claim that that's a business expense, business travel, because it has nothing to do with your business. So it does have to be reasonable. So unfortunately, in this case, the answer is no. But here's why I'm really glad you brought up the question, because this actually leads to a bigger issue. And you're lucky in this case because you went to Tennessee, and I'll explain why in a second. But other folks watching may not be as lucky. And so I hate to sort of be the bearer of bad news. What I'm about to say is going to give some folks some anxiety, and I get that. I want everyone to breathe. We're going to work through this. But here is the problem, excuse me, especially with 2020 and with COVID, is that for the most part, states charge you, or they tax income that is earned in that state. Now, when you live and work in the same state, this is usually not an issue. I work in Massachusetts. I live in Massachusetts. Not an issue. I'm going to pay state income tax in Massachusetts. But with COVID, a lot of people decided to go stay with relatives, or, if they had a vacation house, they went and stayed up at their vacation house, like whatever. A lot of people left what's called their tax home, which is your primary residence, and they went somewhere else. And this is going to open up a whole host of state income tax issues. Now, for you, you're lucky because you went to Tennessee. Tennessee does not have an income tax. Excuse me, they did this year impose, I think it was 1% tax, but that was only on interest and dividends. So potentially, if you have some interest and dividend income, maybe you'll need to look at those rules. But you went to Tennessee. Tennessee doesn't have an income tax. So for you, you're lucky. You are still going to just need to pay, just need to file your California state income tax. And that's it. And actually, I wanted to look at your fuller question, because you said you ended up moving out of your apartment in LA permanently in August. Yeah. So actually for you, this is really important for you. You're going to pay state income tax on your income in California, January through August, because you were no longer a California resident at the end of August. So assuming you actually took the step, you got rid of your apartment, I'm assuming, yeah, you got rid of your apartment, so you're fine. So you were legally a Tennessee resident September through December. So actually September through December, that income should not be subject to California state tax. So keep that in mind when you do your tax returns. But for everyone else, what you're going to want to look at is where you lived during the year. Now, here's where it gets super, super, super complicated. Every state has different rules. So every state is going to have a threshold at which they say, if you made X dollars, or if you were here more than X days, you have to file a tax return in our state, and you're subject to tax in our state on the income you earned while you were here. Now, some states like New York, it's a day. Literally, if you're there for one day, you've got to pay income tax, or you've got to at least file. Other states, I think Arizona is 60 days. So every state is different. Okay. So that's the first thing to know. So if you ended up going to another state, I want you to look at that. The other thing to think about or to realize is that a lot of states have what they call reciprocity agreements. So this is especially the case when you think about states that are very connected. An example would be like New Jersey and Pennsylvania. A lot of people who live in one of those states work in the other. They're very sort of closely connected. Their commerce is closely connected. Their roads kind of closely connect them. So they have a reciprocity agreement, which basically says if you're a resident of Pennsylvania and you work in New Jersey, you'll get taxed in Pennsylvania and vice versa. So states that have that, Pennsylvania and New Jersey have that. The sort of Beltway has that. So like the Maryland, DC, Virginia, this is a geography test here. Pennsylvania, I said Maryland, West Virginia, I think is part of that too. They've got a reciprocity agreement. Excuse me. Other states will do what they call non-resident tax credits. So what will happen, Massachusetts does this, for example. I live in Massachusetts. So if I had gone to, if I'd gone to California for 6 months and I had lived out there, and I ended up, because of that, having to file a California tax return and paid tax on my income in California, I still have to report that same income in Massachusetts because I'm a Massachusetts resident, but Massachusetts is going to give me a credit for the tax I paid in California. So it's going to help to offset that Massachusetts tax that I owe. Now, the trick here is that those credits don't always fully offset, because the Massachusetts credit, for example, many states are like this, give you a credit based on their tax rate. So Massachusetts tax rate is 5%, so they're going to give me a 5% credit, basically. But if I worked in a state and paid taxes in a state that has a higher tax rate, then that credit is not going to fully cover that tax that I paid. Does that make sense? So that's something to be aware of as well. The other thing to be aware of, and this is a particularly frustrating piece of state tax, is this rule called convenience of the employer, or COE. It's the COE rule. It's been around for a really long time. And 7 states have that. Well, 6 to 7-ish states technically have this. And what the COE rule says is basically that you are subject to state income tax in the state where your employer is. Now, many of you are business owners, so you don't have an employer per se. That would be your business. So what this means is, I'm going to use an example, is so one of the states that has this is New York. So if you live if your employer or your business, let's say, is in New York, you started your business in New York, but then let's say you went and lived with your parents up in Massachusetts for 6 months because of COVID. Well, the COE rule basically says that you will be taxed, subject to state income tax in New York, even though you were in Massachusetts for 6 months of the year. What ends up happening in that case is that people oftentimes get double taxed, as you would in the example I'm giving, where New York's going to charge you a state income tax for all your income for the year, because that's where your employer, your business is. You're going to be subject to Massachusetts income tax for 6 months of the year because you were working in Massachusetts for 6 months. Massachusetts will give you that credit that I mentioned. They'll give you that 5% credit. But by the way, New York's tax rate is higher. So you're basically getting double taxed. Some of that is being offset by Massachusetts giving you that tax credit for state taxes you pay in another state, but not entirely. And so what's really frustrating about states that have this COE rule is, in many cases, employees do get subject to double tax. States that have it, I wrote it down here because I didn't want to screw this up. So states that have it: Arkansas, Connecticut, Delaware, New York, Pennsylvania, and Nebraska. Those are the 6 states that always have it. Now, New Jersey has enforced the COE rule on audit, which is kind of weird. But basically, when there's been a challenge, some of the court cases that have come out of New Jersey have basically shown that they are following a COE rule. Massachusetts in 2020 put in a temporary COE rule, and the reason they did this is because here in Massachusetts, we have a lot of folks who live in New Hampshire, which is, by the way, an income tax free state, and work in Massachusetts, and now they're working from home in New Hampshire. So prior to Massachusetts putting this rule in place, all those folks all of a sudden had all this income they were making that wasn't subject to tax anymore because they were working for that income in New Hampshire, not in Massachusetts. So Massachusetts was like, hold on, we don't want to lose out on our tax revenues. So they put this COE rule in place. Now, this COE rule has been challenged. There have been a lot of court cases on it. A lot of people think it's unconstitutional. It punishes employees quite a bit because you do end up being double taxed. So I bring this up because what's so important to realize about this year is if you worked anywhere else because of COVID in 2020 and 2021, you've got to talk to your tax accountant about it. Or if you're doing your own taxes, you've got to look into this because it may mean that you have to not only file an income tax return in an additional state, but also that you have to pay state taxes in that state. Now, what happens a lot, if you were an employee of a company, this is an easier process. Or in theory, it's an easier process because you would have raised your hand and said, hey, I'm going to go work in Massachusetts for 6 months. I need you to withhold taxes from Massachusetts. The problem is when we're business owners, that doesn't happen. We've got to figure this all out. And I'm guessing you didn't pay in quarterly tax payments throughout the year to this additional state, right? Most people didn't because they didn't realize. So definitely talk to your accountant. If you don't have an accountant, this might be the year to get one. And if you're DIYing it, then just make sure you sit down, you read the rules very, very carefully because this is going to be a massive headache for folks, definitely for 2020. And then if you did this again in 2021, it's going to, be a headache for you as well this year. But because of COVID, this is going to be coming up. And a lot of people just don't realize that all of a sudden they may be subject to tax in other states. Was there anything else I wanted to say? No, I think that was it. Those were all my notes. So I'm glad you brought that question up because like I said, it's, you asked a different question, which I hopefully was able to answer for you, but it really brought up this bigger issue. And so if you're, like I said, I can't stress this enough. If you went anywhere else and worked during 2020 or 2021, this is definitely a conversation you need to have. Now, you may be thinking, well, what if I just don't tell anybody? Like, how are they really going to know? And here's the thing, at the end of the day, that's your risk to take if you want to do that. But I will tell you there are ways that they will know. It could be anything as simple as if you ask your employer, we don't have an employer, but if you ask someone to send your 1099s to a different address, or if you get audited, they will pull up, credit card statements, they'll pull up, rent checks and things like that. So this is not something I would try to sweep under the rug. Yes, it's going to be a pain in the butt. I know that, but I wouldn't do that. For many of you, if you went somewhere else for not that long of a time, you may find that you don't meet the threshold in that state for filing. So before you sort of get scared about this and decide this is a horrible thing, let's first figure out what the rules are in that state that you were in. And it may be the case that this actually isn't an issue for you. So that is where I would start. But if it turns out that you do in fact have to file in that state, that's when I would think about getting an accountant, or working with someone who understands this stuff. I will use that as an opportunity to put in a pitch for my done for you tax prep services. If anyone is interested, I still have a couple of spots open for folks who want 2020 tax prep services. I've got a few spots open for 2021 as well. So definitely check that out. Head on over to megkwheeler.com/tax. And hopefully that answered your question. I don't see any other questions here. So I'm going to wrap it up, but I will see you all back here again next Thursday. Bye for now.